Welcome back to our channel, everybody. We're so happy that you're here. We're excited to be here. This is episode 4. We're excited.
Okay, yes, episode 4. We've been doing this foreclosure thing. We've talked to you about that for about the last 3 weeks. Now we have had some folks ask us about mortgage insurance and the deficiency judgments. Okay, with us today, Troy Baldwin with Guild Mortgage. He's going to talk to you about it because he knows more since he's the lender that helps us out.
All right. Well, thanks for having me on. Appreciate it. I got a lot of notes here because there's a lot of important stuff that I need to make sure I hit with this. So we're going to start with mortgage insurance. And mortgage insurance, people think, it's going to protect me. I'm paying for it, and so I'm getting something out of it. Unfortunately, mortgage insurance is set up to protect the lender. And ultimately, in the whole process, it protects the investor who ultimately buys the mortgage. And then they have a servicer service the mortgage. So it's protecting the investor who's saying, hey, I'm going to buy $10 million worth of loans, and they're going to be loans that have less percentage down. So I'm going to get more interest out of those. Mm-hmm. But I need to protect myself in case these people don't make their payments.
Yep.
And so I'm going to make sure that they're paying mortgage insurance to cover me in case they don't make their payments. So mortgage insurance, it's a double-edged sword, but it has to happen in order for you to get a loan if you're doing less than 20% down payment. Okay? So there's a couple things I want to hit is there's private mortgage insurance, which is related to conventional loans, Fannie and Freddie loans. And if you put less than 20% down, you will pay for mortgage insurance. It is variable based on your credit score and your debt to income ratios and, of course, the down payment. Interesting fact with that is if you put 15% down, you will get a better interest rate because you're going to be paying mortgage insurance than if you put 20% down and don't have mortgage insurance.
That's crazy.
So that's a little unknown fact there.
Little hack.
Yep, little hack. All right. Mortgage insurance premium is what FHA uses. So the Federal Housing Administration charges what they call mortgage insurance premium. There's a 1.75% upfront fee that's rolled into the loan. Most of the time, most people don't have the money to pay the 1.75% upfront fee plus the 3.5% down payment. It's really good for people with lower credit scores because it's a 0.55% annual premium. And if you have a 620 and you do a conventional loan, you're probably going to be paying somewhere in the upper, instead of 0.55, you're going to be paying 0.9 probably with a conventional loan. So this helps people who don't have a very good credit score get into an FHA loan. If you put 5% down, it goes down to 0.5%. But the thing about FHA is it's forever. Okay. It does not fall off once you have 20% of equity in the home. So when we do FHA loans, we say, hey, we're going to refinance you when it's time to get you out of the mortgage insurance there with the FHA.
And that's the only way to get it off.
That's the only way to get it off is to get out of an FHA loan.
Okay. All right.
VA, there is no mortgage insurance. VA has no mortgage insurance. That's one of the benefits of being a veteran is you don't have to pay mortgage insurance along with many other things. So if you're a veteran, take advantage of the VA loan. USDA has what's called a guarantee fees, not mortgage insurance premium like FHA, even though it's a government program. It's USDA. They charge a 1% upfront fee versus the 1.75 in FHA, and then it's a 0.35%, what they call an annual fee paid monthly. So it's a lot less than pretty much anything. So if you run into a property that can be purchased as a USDA with a USDA loan, it's actually a really good deal because you can actually finance over 100% of the loan.
Okay.
and get it financed. So USDA is a great opportunity for some people. The cost, of course, that monthly payment of your mortgage insurance is paid with your principal and your interest, HOA, hazard insurance, and all that. Just keep in mind that to avoid it, if you can make a 20% down payment with a conventional loan product, there are other loan products where we can do use as a piggyback loan. So if you get a second where you do 80%, the second mortgage is 20%, and you get out mortgage insurance. There's unique ways to get out of it. Certain loan products don't require it. So, but important things to remember here is mortgage insurance is not the same as your homeowner's insurance. It's which covers property damage, or it's not mortgage life insurance, which people can get a mortgage life insurance policy, which pays off the home if you pass. And it strictly protects the lender/investor against borrower's default. So that's one. And then, it also, as we go into the next topic, mortgage insurance, it does not help the borrower if a foreclosure sale fails to cover all the costs. So,
and we've seen that before.
Yeah, right.
Yes.
And it is designed exclusively to protect the lender against losses. If the sale proceeds are insufficient, the insurer pays the lender, but the borrower may still face a deficiency judgment.
Right. And this is what we've been talking about for the past few weeks to some people off camera too, is if unfortunately your house doesn't sell for
what you owe,
right.
What you owe, they're going to come after you for the difference.
Yep.
Yep.
And that's what he's going to explain.
Yeah. We'll jump into the deficiency judgment. And it not only is what you're short and what you owe on the mortgage, but there's also total debt calculation that goes along with that, where there any unpaid interest, any late fees, any attorney fees, and any foreclosure related costs you're on the hook for. So what is a deficiency judgment? It's a court order that is started by the lender after the foreclosure sale is completed. Mm-hmm. Okay, so the foreclosure sale has to happen first before this can be filed. And lenders have up to 6 years after the foreclosure sale to file the deficiency judgment.
Oh, wow.
Yeah. So if you get your foreclosure sale done and you think, oh, well, hey, we're done, make sure you know all your details and save all your information, because it could take them up to 6 years, because mortgage insurance is paying the investor here, and there's probably mortgage insurance going to say, hey, I'm going to get paid, and be working with the lender. They're probably working together to figure out how to get this money back. Yeah. Right. So after a foreclosure sale, if the sale proceeds do not cover the total debt calculation, which is the unpaid interest, late fees, attorney fees, foreclosure related costs, is owed by the borrower. They can garnish your wages. They can put property liens on other property that you own. They can do seizure of other assets. Now, there is something, it's called fair market value. So if a borrower can prove the lender sold the home for less than a good faith estimate of its value, they can reduce or avoid a deficiency judgment.
Mm-hmm. That's good.
Yeah. That's a good one. And there is another option for people. It's called a deed in lieu of foreclosure. All right. And what this does is you make an arrangement where the homeowner transfers property title directly to the lender to avoid formal foreclosure proceedings, typically settling the mortgage debt. Mm-hmm. This process is faster, about 90 days. You avoid the public record and the embarrassment, and often covers the full loan balance, though it still negatively impacts your credit. But there are some requirements. You need lender approval. So the lender must agree on the arrangement. And if you have a junior loan or a second, you're probably not going to be able to do it, just because it makes it more difficult to get everybody their money.
So is that like a forbearance or stuff like that?
Or like a chapel loan?
Yeah. So like if you use down payment assistance for the house and there was a second on it, or if you took out a HELOC. Okay. And that's, some people, when they start going for foreclosure, they'll take a HELOC out if they've got any equity, and they'll try to keep up with their bills using their HELOC, right? And eventually, if they don't get out of their situation, then they're defaulting on both of them, unfortunately. So, the voluntary act, it's a voluntary action. So both parties must enter into the agreement, the lender and the borrower. You have to present hardship. So you have to have evidence that why, such as the loss of income, you lost your job or whatever. And the title must be cleared. You can't have any other liens against property or, anything that's going to hinder the title transfer process, right?
Clean title. Yeah.
Yeah.
Sounds familiar.
So there are potential tax consequences with the deed in lieu of foreclosure, and that is the IRS may treat forgiven debt as taxable income. So keep that in mind. And there's no guarantee. And it says lenders can and often do reject this option. So, but in favor of traditional foreclosures instead. But it's an option to start with, right? And one thing that we do as a company, and I'm sure other lenders do, but when you sit at the closing table, you sign a document saying you will seek counseling if you can't make your mortgage payment. Seek counseling to see how it can, we can help you as a lender say, okay, yeah, forbearance, let's not make some payments so that if for a few months so I can catch up, and then they'll add them to the end of the loan. There's options, and lenders do not want to foreclose. It's one thing that it's a pain for everybody, and foreclosure is not something that lenders enjoy doing. Right? And they 9 times out of 10 will work with you figuring out how to help you stay in the home.
So on our side, there's a sale date usually from when they file the notice of election demand, and it's been our experience that they will extend that date and work with us because probably everything that you said. That's why they do that.
Well, yeah, because again, lenders don't want to own homes. That's the bottom line. It does. I know how this feels. You have something that happens to you, especially when you see your name in a publication. But the bottom line is once that name is in that publication, now you have an attorney that's probably going to cost you $20,000 just for handling the paperwork.
Yeah.
So it just keeps going on and on. If you are in trouble, please reach out to us because, like I said before, we know, Josh and I at least, know how you feel. There is light at the end of the tunnel because we can get the house sold for you.
It's scary, though. It is absolutely scary. But you know what's scarier is this stuff. I would not, it's very, very, very knowledgeable, everything that you just shared about the deficiency judgment and about just shedding the light from the lending side. But, don't, it's up to you guys. It is. But don't just do nothing. Don't just do nothing.
Yeah. Don't sit there and say, oh, I wonder if maybe they won't call me, yet. I'll wait 3 months before. Don't do that. As soon as you can make a payment, call and explain to your mortgage servicer what's going on as soon as you can, because there's ways to, not let it go as far as the foreclosure.
Right. And like I said, if it's there, we can help you sell it. Get it off your plate already and see if we can help you do something. So this will be the last week that we do the foreclosure stuff. Again, give us a call if you have any questions or concerns. And like I said, we can pass on his name and phone number, and we will put it in there in case you have questions.
Troy, put your number out. Tell the people.
Oh, yeah. Yeah. I'm Troy Baldwin with Guild Mortgage, 970-301-0321. I'm available evenings and weekends if you have any needs during those times. I'm happy to take phone calls and help you out. So, and I'm here for any questions as well. And if I don't know the answer, I'll find the people who might know it and get you the answer. So.
It absolutely is. Thanks, guys, for tuning in. This is all we got. The replay will be on Spotify, on YouTube, and on Facebook. Any questions? If you guys want to get on here, let us know. Have a good one.